What's up, Outliers? Happy Wednesday. Welcome to General Stock Market Update. Today, we just go through the market, see what sticks out to us, anything interesting, and yeah, that's the game plan for today. There's a few specific things that I think we should discuss today, specifically VIX. I think we should talk about the Fed. I think we should talk a little bit about the recent employment data and some individual names. Probably want to take a look at NVIDIA, Tesla. I'm just looking at a dashboard that I built. I also think NFE and IRIN I want to take a look at, and then QBTS. Same thing with SLV for some vol stuff. So we have really a bunch of things that I want to run through today. But as always, if there's anything that's also top of mind for you guys, absolutely let me know. I'm more than happy to take a look. So the market right now is literally, none of my alerts have kicked off, which is, you could see where I'm looking in SPY, the 685 and the 677 handles. This is the area to beat, in my opinion. So right now, I don't really view anything that happened today as super bullish, bearish. Definitely leans slightly more bullish than bearish, but it's still in this range. And for those that aren't like fully up to speed with where at least I'm viewing the market right now, it's as long as the market remains in this consolidation zone, it's in the consolidation zone. So I cannot definitively say up or down when it's sideways. This is also one of the periods where trading things like the coverage strangle in index ETFs is actually quite useful. I'm in the process of making a bit of a video about one of the management approaches that I use in stuff like that to help manage timeframes like this. Because if we really think about it, the market had a bit of a rally back here on 28 October, and it's in effect gone down slash sideways that from there. That's what we've seen. A little bit of an up move, then a little bit of a down move. Again, this isn't like any sort of crazy down move, but a little bit of a down move, a little bit of an up move. Like this range, this box has been the case for a little while now. Having a solution to trade during markets like that, especially if you're trying to do this at a consistent level, you have to have something to do during stuff like this. And there's a bunch of things that I like to take a look at, but one of them is maintaining the long beta through the coverage triangles and the indices, but then also is the speculative bag. And I was just doing a little bit of my monthly AAR, sharing where the portfolio is at. This was yesterday on the stream yesterday. I was sharing just some portfolio level metrics, but suffice it to say, so far, this has been a really, really good year for me. Right now, it's firmly third best and potentially the second best, but it's a little too early to tell. My expectation is a little bit more towards second best, but we're a few minutes in, so let's see who's found their way in. I see Reese, Kirk, ZX, Lauren, Brain. Great to see you all. Brain says, was just in the middle of watching your Doomberg discussion. Cool. Yeah, that's for those that are unaware. There was a podcast that came out earlier today. I try to do podcasts. Those come out on Wednesdays when I have them. I target 2 a month. And this last month, actually, we did, I want to say 100 and change. So a decent number of podcasts for sure. Also, Shredder, what's up? Good to see you. Thanks for coming to hang out, and I'm looking forward to poking through the markets with you guys. But let's take a look quickly at where things sit. From a broad market lens, there are a few really, really important trends that are worth your attention. The first one, for those, again, that are more kind of in the cadenced streams, you know that I look a lot at breadth. And breadth here looks Okay. We see the percentage of S&P companies above a 50 period moving average is now over 50%, which is good. That is exactly what we want to see, especially longer term. And the reason for that is it shows that the rally or the current price action isn't being hyper siloed in just a very few number of names, which is important. You can have a certain number of companies move the market and support the market. And as much as we like to joke that like Nvidia is single-handedly propping up the market, which again, Nvidia has a massive impact on the market. But if Nvidia was doing really well and somehow everything else was not doing well, the S&P would be down. Nvidia is super important, but it is not everything. Now, again, that's not how markets work. If Nvidia is doing well, that typically means a lot of their partners and stuff are doing well. But in a vacuum, that otherwise would be the case. So looking at broad participation is in your general interest when you're trying to get a sense of like, how do I feel about the markets broadly? How do things look at a high level? And this is actually really important because we're seeing slight expansion in net highs lows across New York Stock Exchange and NASDAQ. That's a really useful metric because it doesn't need to continually grind higher, but what it does need to not do is grind lower after it peaks. So it can oscillate above zero and have some level of positive net highs lows. And the oscillation is completely normal, but it needs to not trend down. And the print today is it not trending down, which is good. There's a couple downsides to the market right now. One of them is vol is at 16. That starts to become a little oppressive for general vol trading strategies, especially in the indices. It's way, way, way more constrained now. So for example, 0DTEs yesterday and today were very good. On Monday, they were not good. And one of the funny things is if you take a look at where vol was on Monday, vol was a little bit higher, but vol has been steadily trickling down. Now, again, VIX is 30-day vol, so it's not exactly same, but it's a good proxy for what you're going to see across the curve. Because of that behavior, the way that I look to trade markets does change a lot. And it's because the risk to reward profile for what I'm doing changes pretty significantly. And I'll literally give you a direct example. Let's go back. I'll find some 0DTEs from like November 20th. Let's find something from around there. Okay, so I see one here from the 17th. And on this, I'm seeing effectively collecting for a short strangle wrapped around like a 28 and 26 delta short call, short put respectively. Those are giving me like almost $2 more than what I've been getting the last couple days. That's really, really important because when I'm taking that risk of intraday vol, if I'm not compensated well enough for that risk, then when we have losing positions, then the strategy doesn't do as well. And actually, the last 3 days is a perfect example because the loss that came through on the 1st of December, which again, Monday, the loss of the 1st of December is enough to overwhelm the wins for both of these days. It's very minorly so. It's like just negative, but nonetheless, it is negative. 1 losing trade to 2 winning trades. That happens when vol gets really, really compressed. And it's because when vol is really, really compressed, we would expect to see a higher win rate for these things. But this is where having a nuanced understanding of volatility is very, very important, and it takes time to get it. Because a lot of times people are used to more so what we would refer to as like the tasty methodology, which again it's a starting point. I don't actually agree with some of the core concepts of it, and I'll explain to you why. All of this stuff is measurable So as I talk about it, you should take what I say with a grain of salt, and you should try and test for yourself because you'll learn a lot. But if we take a look at VIX as a general level, right? So let's say that this is VIX 0, and let's say that this is VIX 100. Generally speaking, what you're typically told is when vol is high, so let's say that this is like 80 and up, that we should sell. And then when vol is low, we should buy. The issue is, depending on where you're at on this scale, it's almost backwards. Not quite backwards, but almost backwards. And it's because it's playing a couple incorrect things, one of which is like the mean reversion of vol and when that actually occurs, which again, we can literally look at it in VIX and see how long it clusters before it goes through a transitory phase. But in here, normally what's happening is when vol is up this high, typically speaking, you will find that this is closer to fair priced, if not slightly underpriced. And this can be a lucrative time to actually buy. The inverse happens when you're down towards this bottom end of the range, but not the very bottom of the range. And again, this is the nuance of trading. Because let's say vol is down, and I'm using this as like a total range, right? So like 100%, 20%. Down at the bottom of this range, so when you're in like the bottom 5% of printing, this is also a bad time for selling vol. So this is like bad to sell. This is bad to sell. This is okay to sell. Say like this is, 65%. This is fine to sell down here. Anything maybe from like the 10% to the 65, this is fine. When you're trading vol, there's a bunch of things that you're doing that aren't really talked about well or frequently enough. And I don't think a lot of people fully grasp what's actually happening under the hood. Because what you're really trading is the implied vol relative to the realized vol. So for example, if you sell vol, IV, vol, when it's high, let's say you sell what you think is high vol, and your expectation is vol mean reverts. So you think vol is going to trickle down. That could happen. Here's the problem. If that happens, but this still increases enough, it doesn't matter that this happened. This overwhelms this. This is your delta move. This is Vega. This delta in this context overwhelms your Vega. So it doesn't even matter if you get the thing that you're trying to get if this other circumstance happens. Which is why when you get into options over time, you'll develop an intuitive understanding for these relationships. My guess is if there's somebody relatively new to the channel in the chat right now, this might sound like fucking nothing. This might sound like just absolute gibberish. And by the way, if it does, you should tell me so that I can explain it to you or figure out the spot that's getting you stuck. But that would be my guess. And it's because this stuff isn't as commonly discussed, and it is partially because it'll turn people off. Like there's a reality that if I go too far into the vol side of stuff, that the stream would probably die, except for the diehards that would be here anyways. And it's because they're masochists. They like a little bit of pain, which is fortunate. You have to endure a little bit of that in the markets. All of this goes back to where I'm seeing the market right now. Because if we look at where vol is as a percentile for VIX, this is super low for realized vol, super, super low. That creates a little bit of a problem. And I actually think, one sec, I think there's a study that I recently did that should show you this. Fuck, I don't know the name of it. It'll be on this one. I just don't, I have so many different random studies. It'll be on this one. What I want is the realized vol as a percentile. Let's go to VIX. So the interesting thing is, if we plot like a 5-day version of this right now, the 20 period realized vol is 63%, really high. And you would expect that, right? Over the last 20 days, we've gone from almost 30 down to 16. It's a 50% move. So if in this we added one more version that was like a 5-day realized vol, you would have a completely different picture of what's actually happening right now. The curiosity when vol gets this low, and something that's really important to remember, is that there's always shit to do. Just because vol is low doesn't mean that you can't find vol. It just means you have to go look for it in some other places. And you'll be able to still find pretty interesting stuff. So let's talk about that a little bit. Some of the interesting stuff and some of the other places that you might be able to look to find either long or short style trades. And I'm talking in terms of premium, because if vol is low, like really low, you kind of don't want to do anything, especially because if you buy, you need something to move to make money, premium. If you sell, you want to collect enough premium for the risk that you're taking. So it kind of puts you in this really awkward spot that sucks. There's really, really strong mobility going on right now. Specifically in financials, there was that new regulatory change in terms of how much capital that they have to require at the large banks. They like that. We can also see the massive difference between staples and discretionary. Discretionary's had a near meteoric rise relative for what it is. One of my basic concepts for trading is this idea of stacking strength. It's looking for things that are doing what you want for your idea. So I wouldn't confuse strength with upside. You can stack weakness or stack strength to the downside if you're trying to play something to the downside. Right now, utilities looks absolutely prime for a drop. If we look at utilities broadly as a sector, it is hanging on by an absolute thread. And this close here is the first print below this general consolidation zone. This, to me, starts to look like downside and really, really early downside potential. The next major stop that it has is like down here, something like this. That range, it needs to cross this gap before it starts getting into any sort of at least longer term price history of strength. This is a completely viable starting point if you're looking for an idea. You can do better though. The way that we do better is we go inside of the sector and then we figure out what's dragging this thing down. Actually, let me go back really quick. Take a look at this. If you look across the deceleration of these things across all these longer term and shorter term moving averages, again, this shows you a massive amount of weakness. So if we go inside utilities and we try to figure out where is this weakness stemming from, one of the first things I would do is, again, look for weakness via momentum. These are the things that have been shitty and continue to be shitty. A good example so far that I see here is PCG. So let's take a look at PCG. To no big surprise, they had a accelerated drop through this consolidation, and so far a fair continuation of this. Now, this actually looks interesting to me for a few different things. If we're keeping it a buck, as far as some sort of like large downside expectation, I don't really think I would have that until below here. It needs to get through this, which at least in the near term doesn't seem super likely, but if it does, then that would be floodgates down. This is the kind of play where I prefer selling calls, something like that. The reason why I'm not super interested in buying puts here is because the downside velocity just isn't that huge. Although if you add enough leverage, you can still get a decent move. And here's what I mean by that. If we take a look at a couple different trades to give you an intuitive sense of what this might look like. If I sell effectively an at the money call, the 16s, we get 32 bucks. Okay, cool. That's scenario one. Scenario two is if I go a little further out, these are at least liquid enough. Let's say that I buy a in the money, slightly in the money, long put. We get rid of the short call. We just look at the long put. Then let's take a look at one other scenario. Those were what, 143 bucks. So let's say instead we go here and we get 6 of these. You get them for like 30 cents. I guess you can only do 5 to be same size. If we do 5 of these, you now are at 150 bucks in terms of what you're pulling up. But the more important aspect here is let's just see how these behave in different moves. On the short call, if you get a 5% move against you, or I'm sorry, if you get a 5% move against you, let me get rid of, fuck out of here. You're going to lose 35 bucks. 10%, you're going to lose 82. 15%, you're going to lose 141. And so on and so forth. If we go to the put side, the long put here by itself, you lose 45, 75, 97, right? So a little bit less on the loss side, and then quite a bit more on the profit side. The drawback here, as you guys know, is theta. And then if we go more of the unit approach, you can see that the total downside is much less in terms of where you would be net in a 15% move against you or a 10% move against you. But your downside is actually if it goes down, your profit potential is much better. And it's because you've brute forced deltas by accumulating 5 of the 13s, which are 30 cents in this scenario. You get down to 81 short deltas versus the 57 deltas that you get from the slightly in the money versus the 35 delta that you get from the short call. Brain says, aren't utilities and AI narrative joined at the hip for some time now? Let's see. Let's take a look at utilities and let's compare it to QQQ. What do we see? Depending on how you structure and how you feel about attached at the hip, I see a relative correlation that absolutely breaks apart. Both of them peaked moderately here. And then the response after the peak is quite different. We had a more aggressive down move here, followed by a way more aggressive rally here. And same thing with what you see here, a big difference between this and this. So if we then just take a look at the actual plotted correlations, for a 10 period, I see a 22 correlation. For a 30 period or a 20 period, which is 30-day realized, a month, I should say, is 28. 50 period is 23. 100 period is 77. What does that inform us? Well, it clearly informs us that things that are nearer term in these is actually breaking down in terms of the relationship and in terms of the correlation. The longer term correlation in here is definitely quite strong on a relative basis. And out of curiosity, I'm going to actually scoot out that 100 period correlation and let's make that a 120 period correlation. Or actually, let's do 6 months. Yeah, do that. It's 86. It's even stronger. As you get further and further out, it's very, very clear that that correlation becomes stronger and stronger. But alas, it breaks apart, and it breaks apart actually quite regularly. What this tells me is that the longer term relationship is actually quite strong, but it's decoupling in the near term. It's exactly what you're saying. So would I wager longer term that they would play more in line with one another? Yeah. But does that mean in the near term that that's what happens? No. And you can literally see it happening with this move so far. If this thing, like I said, if this thing starts aggressively moving down below there, to me, that's a really, really easy trade. It's not easy in terms of like, oh, I know it's going to happen, but it's easy in terms of risk reward based on like where I would expect it to go versus where I would manage risk at. It would be an easy trade, comparatively. I did want to talk to you guys about some specific stocks just because of where they're at in their cycles, Nvidia being one of them. This consolidation is actually not looking that strong to me. If we look at how it's behaving so far, it's still very much in a downtrend. It's in a defined downtrend. This base so far looks good, but the base really, really, really needs to hold. And if we start to see an acceleration down below this, I actually view that as like quite bearish for the market. And as you guys know, I'm actually trading TQQQ's covered strangle. So what that means is I am very interested in how this ends up behaving, because if it goes too far and it starts rolling off, well, then that means I'm going to be paring down risk in the covered strangle pretty quickly. I cannot say that name. And the question, though, is do we see a bone cone coming for GameStop? This actually looks good to me. The earnings catalyst I struggle with, to be honest, to get a sense of like how the market is planning to play this. I also think that at this point, there is a little bit of a fear that more rallies are just going to be met with more offerings, which is, that's a tough one, because then as holders, you don't really want to see price going up that far or that aggressively, specifically because then you don't want to be diluted. And if there are more offerings at these elevated prices, that I think is a general fear. When I look at what vol looks like in here and what the market looks to be expecting, it actually is not pricing in much, literally at all. And it's, you know, the 91% for an earnings release for this thing, which is actually very, very light. TCM says, I don't think more offerings with warrants. The warrants are the current offering. They are, but they're not. Like, that's the thing, is there's a difference between something that can become cash versus cash. For example, if GameStop rallies up here to the 28 handle, which isn't the 32 handle, if they choose to do an offering, then they realize that cash. They still haven't experienced any additional dilution from the warrants yet. My guess is that would be on the roadmap, and my hope would be that they wouldn't. But that all being said, the warrants, the reason why it's such a good play for GameStop is because, like, it doesn't do anything. The only thing it does is that if GameStop has a relatively very high price for what it is, then there's an opportunity to access cash through those. It's really hard to say, to be honest, because normally speaking, I wouldn't expect that. But especially with GameStop, what's so confounding to me is how much cash they're sitting on. And they've been sitting on a lot of cash for a long time, man. That is bizarre. It's very, very weird to do that. And it's also very, very weird to continue to raise when you already have billions in cash. They could really do a lot with that. The reason why that leads to the sentiment that I have is I would have thought prior that they wouldn't have done additional raises, and they did. Which begs the question, is whatever they're looking to do with that cash really, really expensive? And do they need more money? And if they need more money, it would not surprise me to see another raise, another dilution, and with the warrants. Because again, it's really hard to say what the broader idea is in terms of cash. But maybe GameStop is saving cash to invest in Outlier trading. Well, fortunately for them, the operation here comes pretty fucking cheap because we effectively don't make any money. So I do believe if that were the case, they have met and exceeded the threshold for some time now. So now I think it's just a matter of when, Cohen believes that it's the right time. But the cash picture is it really is very, very interesting. The way that their balance sheet looks and what it seems like they might be trying to do. It's from an investor standpoint, I think I've said it pretty clearly, but it is very confounding. You don't see this type of playbook very frequently. Now, of that, I did make a couple adjustments to my GameStop position. I had the 19Ds 22 puts. And what did I do here? So I had the 19Ds 22s, and I just took a little bit of size off. I did that back on back on, what day was that? One second. I literally have to calculate the date because I don't have it here. So we were here, and then we were this far in the trade. 2Ds. So 2 December. Here, yesterday. And I ended up getting back into the 22 puts in 19Ds, but just at a slightly different size. And then I still have the 24 calls. It's effectively coming in as a earnings play at this point. I purposely didn't want to move them too far out. TCM says, what do you think of the warrants diverging from the 32 OCK 26 calls? What are the warrants at right now? 418. 418 and October 26. 32s. It's a pretty meaningful premium. I'd have to think on that a little bit. There's a million different factors that are going into this, and I just am not sure which are going to be the more profound. So the cost to carry is a big one that comes to mind, except the financing cost for GameStop has come down significantly. It perpetually was hard to borrow but now it's been easy to borrow for some time. So I actually don't know what the short carry rate is. One sec. GME short interest. Normally, I think Fintel typically has a good snapshot of the cost. Does it? I guess I'm confused. Not there. Is it on Benzinga? Where the fuck is the rate? Why is this being difficult to find? Do you guys know what the current rate is? I'll check another dashboard. Literally thought that it was here. I don't know what I was thinking. I'll check Benzinga. I think they're one of these tools has it. I know that. I've seen it. Seen it with my eyes. Let me see. Short interest. Float, percent of float. I don't see it. Let me ask AI. What is the current? See. Because that'll be a part of what you're seeing. TCM says, yeah, there was always a small premium, but they've been tracking well, but now at a much higher premium. The interesting thing there is that there's like some pretty tradable ideas that come from funding differences like that. It can be difficult to monetize those, especially as like a standard retail trader, but more advanced retail traders, literally, there's it's not a complete ARB because there are inventory and process oriented risks, but this says about 0.53% APR. So that'll be part of it for sure. The overall rate for the short will be part of it. The other reason for that premium though, like it just seems a little wide to me. Let's take a quick look for context. Let's just see. Let's look at these side by side really quick. Okay. So that part is pretty clear. Let's give this one a color. We'll go to good old maroon. And let's send it to. So now what I'm doing is I'm comparing the price history of that call specifically against these. This itself is also quite interesting, isn't it? This difference. Because that is a pretty clear, stronger transaction. So part of it looks liquidity based to me. Yeah, I think that's the two main things that I can see. TCM is it looks like a little bit of a liquidity factor specifically from yesterday in the order flow, because that led to a pretty significant gap and then a price small trickle down off of that, but super small volume. That's the other problem here, is that the liquidity gap that you see here is the volume on this is 204 contracts. The volume here is 10, whereas the price discovery on this is going to be way better, 1.8 to 1.7 mil. So there's just way more trading in here. So I would estimate that it's really a function of those two things. That's the broader thing that I see here. The cost to carry, little bit of tracking error, but then also literally just base liquidity gaps. That's what I see. QQ says, what platform is this? This is Thinkorswim. Same platform that I have been using for a hella long time, but it's pretty solid. It in general does what I need it to. Let's talk about one or two other things really quick. I want to talk to you guys. We can skip Tesla. Let's take a look at NFE, because NFE popped up today for a few different reasons. That was kind of fun. This one definitely, well, I don't know if it's like a strong meme stock, if it falls into that bucket. That part I'm actually not so sure the true classification for it. But this thing had, at least in a really short term, had pretty weird price behavior. And I was following the options chain on it. Every once in a while, I'll kind of like pick a few tickers that I just arbitrarily want to keep an eye on and follow. And this ended up being one of them. This part, I thought, it was the last few days, this part. Take a look at that. The put premium has absolutely skyrocketed relative, even though price is starting to rally. When I see those kinds of things, it always draws my eye because that's abnormal. Typically speaking, when you catch this kind of behavior, right? Like, so a bunch of short put premium puts being sold either from recent profit or just short puts being offered net new. But then this is clearly demand for long puts, and significantly so. So I was looking at where it looked like those were getting done. And we can see that there's a massive build out here, except these look more so on the sold side because these came in. We could take a look at the contract itself. Oh, actually, that's a lie. It looks like a healthy mix, actually. Oh, I see. Because it's just giving the last price versus the average. Okay, got it. What was confusing me there is I was taking the last here, thinking that's when that transacted at, which is, it's kind of annoying. It would be much better if it didn't do that, but that's okay. These are pretty long dated though. That doesn't necessarily mean a whole lot to me when I see that long of a duration. So out in March of 20, but this is anomalous. And here's the other thing that's anomalous: fives. It's a 5 put. Stock $1.38. What do you guys think of that? If we're looking at the 5 put out here with 113%, or 113 times volume over OI. What do we think of that? Does anybody have any inferences that you can navigate from there? Because the cool part is, again, as usual, if you can figure out what some of those things might mean, you typically can create a trade idea out of it, which is kind of fun. Brain says someone selling deep in the money puts. Kirk says, could that be bullish sold? Good questions. Let's take a look at the economics of it. The majority of this volume came in when it came in at an average of 398. If we plot the bid and the offer on the day, it overwhelmingly came in on the offer side and the upper mid. So what that tells me is that the majority of these are way more likely bought than sold. So it's a good question. My best inference here is that these are bought. Brain says so far out of the money. These are deep in the money. Remember, these are puts. So they bought 5 puts, 5 strike puts, I should say, not to confuse you with the number. 5 strike puts when the underlying is at 138. So these are deep in the money, very deep in the money. TCM says seems like some kind of weird hedge for some other derivative. Could be. What else is this sometimes? Synthetics. So sometimes here, this literally can be designed as a synthetic position in trying to, the reason why you go so far in the money on things like this is because you actually want to nullify most of the Greeks. The funny thing is because of how volatile this is, it'll still have some extrinsic value, but just not much, right? And you can do the math always to get a sense. It's, $3.62 of intrinsic. So the extrinsic is 30 cents. It's just not much. Because of that, the rest of the Greeks really don't matter that much. Your vega doesn't matter that much. Your theta doesn't matter that much. But what do we notice? It's hard to borrow. What does that mean? It means that if you wanted to short shares, it can be probably more costly to short the shares. So again, kind of like a funding rate arb, this could be a directional idea, or this could be somebody playing the variance between whatever the funding rate is for the hard to borrow on the underlying versus the implied cost to carry of these puts. So it could be a non-directional bet. It literally could just be playing that. I don't suspect that to be the case, but it could be. This to me looks way more of an extrinsic value, or I'm sorry, not extrinsic value. This looks way more of a synthetic play. Kirk says 30 cents of extrinsic is almost 10% of that stock value. Well, it's not, right? We got to make sure that it's almost, but it's not, which is a pretty big difference. So if they got it for $3.95 and the extrinsic is 30 cents, it's 7.5%. Right. And again, I understand your point that 7.5 is close to 10, but in the financial markets, that's a big difference. This is just likely based on the funding rate right now. My guess is a much cheaper way to get short, and we can sort that out. We can figure out maybe what the cost is to borrow NFE. So let's see. What is the current cost to borrow NFE from Schwab? I'm just using Schwab because that's who I have. Let's see. I don't actually know the answer. Does this have the cost? There it is. Finally. I thought that I knew that it was on here. I thought for sure that I seen it. So now I do. Here we go. So these actually look pretty expensive. So this looks like just a cheaper way to get short, to get synthetic short. Remember, this is a percentage. This is an APR. So this is absolutely super expensive. So yeah, that's what it looks like to me. A cheaper way for somebody to get short without getting hammered by these rates. You go deep in the money, you get rid of all of your other stuff, meaning the Greeks. You don't really care about delta anymore. You don't care about gamma, theta, vega, rho, charm. You don't care about any of it. That is a delta of 1. This is effectively as deep in the money as you can go. Well, not quite, but pretty deep in the money. So it's going to neutralize like all of the other Greeks that you see. So that's exactly what I detect going on here, which is actually kind of fun to see, if I'm being honest with you. Because it's not super common to see those kinds of positions, especially in smaller float, stuff like that. Those are the kind of things, though, where I infer that that's probably a pretty informed participant, is my sense. Brain says NFE shot up 12% today, so those puts got cheaper. The fundamentals look terrible. Massive debt, virtually no revenue. Yeah. What was their earnings before? They even did worse on that earnings. How'd they do here? They did terrible on this earnings. So this actually does look like really, really awful. I'm going to add this to my watch list because this might be something that I play along with more out of sheer curiosity. But again, this one is also a pretty cheap asymmetric play. Kirk says, can you take a look at iron? Yeah. What do you want to look? What are we looking at? What do we see? Iron. I need to zoom out a little bit. 3 months is. What are we thinking? In my take, how did it do on earnings? 14 cents. Kirk says they had a $1 billion offering yesterday, but held support. Whoa. Oh, okay. So they offered. So they just diluted. To me, it looks bad. But these are the kind of things that I wouldn't do much with until it gives me some sort of direction from a directional lens. But the vol side, see, even the vol doesn't look that good to me. It doesn't look bad. No, that's a lie. Yeah, I take that back. I take that back. I take that back. The realized 10-day move is 10%, 20 days like 34. So it's a 34% move, but a 94% range, which is fucking nuts. But Vol is at 120. So this actually looks a little bit curious from a vol lens. Super tail happy in the front. And definitely some kinks in the curve. From a directional lens, it would need to effectively move outside of either of those alerts that I set. I don't look to try to guess as something's consolidating which way it might break. But I don't love this, right? Take a look at that. Somebody was running up the calls as this thing was rallying, and then they literally flattened. And then this thing started trending sideways. So the net here is like short 3 mil in change. To the upside, the long was like 5.7. So somebody, to me, it looks like they were literally just day trading a little bit. Wow, there's a lot of like really, really short-term shit. That's pretty impressive. And people are buying upside. They're just not buying it with much money. They're really just putting up cheaper ways to get some upside. That's super interesting. Vol is pretty high across the curve. Definitely put skew. Look at that. And then look at that. Jesus Christ. Does this thing has to have something going on. What the fuck is that? Look at that. 132% vol, 109. There's something. The market looks real mixed on this. The risk premiums are starting to flip a little bit negative, which is actually a decent time because the risk premiums themselves, when they get down too low, they tend to mean revert. Okay, so to summarize what I'm seeing here, the underlying itself looks bearish. It's in a consolidation range effectively from 12 nov, still trickling down though. It's just now posting a low cycle, but it's still lower lows than this. In order to break out of the trend or the consolidation to the upside, it needs to get above like this 50 3/4 handle. And then if it breaks down below, then that's when it falls below like the 40-15 handle. Directional preference right now, based on current trend, would favor bearish. Based on the options market and what we see here, it's a little more of a mixed bag, but I still think a little more bearish than bullish. So yeah, that's generally speaking. Generally speaking, what I see. Yeah. Kirk says it's a paper trade, so I'm trying to watch how it moves. What did you do in here, Kirk? Did you get long? Synthetic long 40. Yeah, I got it. Okay, that's kind of a bummer. I definitely, and I know it's a paper trade, but I still treat those like real trades. I definitely hope that it works out, but in terms of like a value proposition and just a good strategic programmatic bet, I don't personally love it. I just don't like how weak this looks in the front. Looks like really, really weak. In terms of stacking strength, it has a lot of stuff going against it. But as always, that doesn't mean that it can't make money. But the way that I look at pretty much all trades, including this one, is always like, not is this one the special unicorn that bucks the trend, but more so, is this the kind of thing that I think is more likely or less likely to have a favorable move based on the position that I put on? Because when I look across 5 days, it's negative, 10 days, it's negative, 20 days, it's negative. It's not until you get out to like 3 months and 6 months, which from a momentum perspective, there could be an argument for a reversal. There could be an argument. It's just a little too early, I think. It's a little too early, I think, to call it that way personally. But yeah, it's an interesting one. And it does look like there's some knowledgeable participants. The NFE trade to me definitely also reeks of that kind of positioning. So, all right, gang. It is time for me to bounce. I'm going to go work on a video, be an outlier. See you guys later.